Hello, everyone, and welcome to today's webinar, Bear Markets and Investor Amnesia. This event is part of our Institutional Access webinar series. I'd like to invite our speakers to unmute their lines and turn on video. During the webinar, please submit your questions to our speakers through the Q&A button at the bottom of your screen. We'll save some time at the end of the discussion to answer these. The session will be available on demand. All registrants will receive an email once the recording is live. I'd now like to turn the event over to Blockworks Group's co-founder, Michael Ippolito. Mike, please go ahead.
Thanks very much, Julie. Just a couple of really quick opening words about Blockworks Group and institutional access before I turn it over to Jamie, Dan, and Morgan. So Blockworks Group, we are an events and media company. We put on live events, produce a network of podcasts, and we put on educational talks like this, really with the goal being to shine a light on some of the most important stories around traditional finance and investing today. So that could be anything from the pension funding crisis to the potential end of the risk parity trade, to the just topic of inflation versus deflation and all the action that's being taken by central banks, and to really put some of these complicated issues in plain English, right, so that everyone can understand them. So today we're really, really lucky to be joined by Morgan Housel of Collaborative Fund, Dan Rasmussen of Verdad Capital, and moderating Jamie Catherwood of O'Shaughnessy Asset Management. And we're going to be talking about bear markets and investor amnesia. So basically, I'll let kind of Jamie take it from here, but we're going to be looking at some historical examples of market panics and kind of using it to draw analogies to what's going on today to kind of understand some of what the Fed is doing and how that impacts investors. So without any further ado, I'm going to turn it over to Jamie Catherwood.
All right. Thank you, Michael, and thank you, everyone, for joining. And special thank you to Dan and Morgan, two good friends who I'm excited to have this conversation with. I think we're going to have an issue of staying within time rather than trying to fill time. So with that said, let's kind of get started. The way I figured that we would break up this webinar is kind of two sections, and Dan is going to fill the segue perfectly with some discussion around what he calls the Financial Accelerator. But first, I want to start with this idea of human psychology and kind of investor behavior. And there's no better person to talk about that than Morgan Housel. And he recently wrote a long-form post on the 1929 crash. And Morgan, I just wanted you to start by talking about your idea of history is interesting because nothing is inevitable. And I think it's easy to look back at financial history and think that the people who didn't see the crash coming were stupid, and that the behavioral biases that people back then fell for are ones that we would never actually succumb to ourselves, which is obviously not the case. But I think it was really interesting the way you outlined your post and some of the key points you made. So just broadly, if you want to talk about this idea of human psychology and how it applies to investing, I think that'd be a great starting point.
Yeah. Thanks, Jamie. So it started about a decade ago when I did an interview with Robert Schiller of Yale University. And during the interview, he mentioned something that stuck with me. He said, not a single person forecast the Great Depression. And he said he's spoken with economic historians, dug as deep as he could. You can't find one single person, not one name of someone who predicted that the Great Depression from 1929 until about 1933, when it bottomed out, was going to happen. No one. And that stuck with me because this is like the biggest event of economic history. This is the 10,000 mile wide meteor coming towards us. And if no one could see that coming, what hope do we have for predicting normal recessions? So that just stuck with me. This is the biggest one that we've ever experienced, and not one person saw it coming. And I think, honestly, even though this was Robert Schiller, winner of the Nobel Prize, when he said that, I was almost incredulous. I kind of thought, how is that possible? Because even 10 years ago, and I've done a lot more research since then, but the bubbles of the 1920s, what took place in the stock market and in debt markets leading up to the Great Depression, are very well documented. And we know that. So I just found it incredible that given what we know about what happened in the 1920s, no one saw this coming. So what I wanted to do is go back and read newspapers from the 1920s and the early 1930s to see what were people actually saying at the time. Not what did historians piece together and kind of cherry pick. I don't mean that in a negative way, but most history books are cherry picked. You pick out the big stories that fit your narratives and the big personalities, the big examples to try to show what happened in the past. But if you just go back and read the Wall Street Journal from a random day in 1928, what were they talking about back then? So I went to the Library of Congress and started just poking through those in the Wall Street Journal and the New York Times and some other newspapers from the late 1920s to see what were people saying during this period. And I think it's impossible to think about this with a purely open mind because I know how the story ends. We all know how the story ends. So when you go back and read the papers, you're not exactly unbiased when you're reading the stories, but you do get a sense that even the smart people, the people who had all the information and whatnot, didn't see it coming because it wasn't inevitable. The Great Depression was not inevitable. There were big, misallocations in the 1920s. Stock market rose a tremendous amount, but I still don't think it was inevitable. And when you go back and you read what people were saying back then, you kind of get that idea. You mentioned like the psychology piece of this. I think a big misunderstood part of the Great Depression was what happened right after World War I and leading into the early 1920s, the first few years of the 1920s, which was World War I was obviously a very tragic event in the United States and around the world. And then we had the flu pandemic, which we're more attuned to this year than we ever have been. And then in the early 1920s, there was a very deep depression. It was short, so it's not as known as the Great Depression, but it was very deep. We had 20% unemployment. And you start reading the newspapers, and some other history books have talked about this. People were just tired of being tired. They were tired of the amount of misery that had been endured in America. They were just ready to go have some fun again. And that was kind of the seeds of the 1920s, was people like, I'm so sick of tragedy. Let's just go have some fun. So once there was a little bit of optimism in the 1920s, a little bit of economic growth, people just said, I want that. Give me that, and I'm going to hold on to it and not let go of it. That was kind of the seeds of the 1920s boom. And then the other thing that really sticks out is I think there's two kinds of bubbles in financial markets. There is what you might call a valuation bubble, which is when earnings stay the same or there's no earnings available, but prices just keep going up and up and up. That's one type of bubble. That's like what we normally think of as a bubble. The other bubble is a lot more nuanced. I would call it like an earnings bubble, for lack of a better phrase, which is when the economy itself, like in fundamental ways, is usually over leveraged, or just the earnings that are coming out of businesses are not sustainable. And that is a lot of what we had in the 1920s. And that's important because if you go back and read what people were saying in the late 1920s leading up to the Depression, they weren't largely talking about, oh, the stock market is so overvalued based off of this metrics. What they were talking about were things that make rational sense, like earnings were at an all-time high and earnings were growing and profits and wages and whatnot were surging and at an all-time high. Things that could back what was going on in what seemed like a fundamental basis. The other really important thing that I'll mention about this before pausing and moving on is that a lot of the fundamental metrics that we use today to measure the value of the stock market, discounted cash flows, the CAPE valuation metric, the PE ratio, something like super, super basic, literally didn't exist. We're not in the public wealth knowledge back then. So in the 1920s, people just didn't have the analytical rigor that we do today, that even like a CFA level 1 candidate has today. Even like the partners at Goldman Sachs didn't have that kind of knowledge in the 1920s. The first book that really codified or that kind of laid out how to rationally value stocks was a book called The Theory of Investment Value, which was written by a guy named John Burr Williams. And it came out in 1938. That was really the first book that laid out discounted cash flows as a way to properly value stocks. It was a decade after the Great Depression began. So if you go back to this period, they weren't talking about overvalued stock markets like we do today because they literally didn't have that knowledge back then. It just didn't exist yet. So you put all those things together, combined with the most important fact, which was what happened in the Great Depression was this kind of like wild confluence of events that I think just could not have been known in 1929. And no one really saw it coming. There were people in the 1929s who said the stock market's overvalued, but anyone who said the economy is going to collapse and the market's going to fall 89% and lead to 25% unemployment, no one said that. And I think no one said that not because they were stupid. They didn't say it because it was not foreseeable and it was not inevitable.
And what I found really interesting from your piece was that there seemed to be more of a focus on just this general kind of idea of prosperity versus people talking about stock market earnings and valuations, and this idea that America had kind of conquered or tamed the business cycle. Like booms and busts had happened, but that wasn't going to happen anymore because we kind of figured it out. And although history is rarely different this time, you can, as you said, kind of see why someone would feel that there were reasons to believe that something had changed. And one line that stood out to me was you said, when you go from a horse to an airplane in one generation, taming the business cycle doesn't sound outrageous, does it? And you have to think about that. I mean, really, you go from a horse to an airplane, like there are things that are just happening so quickly and they're so pronounced that something like defeating boom and bust cycles doesn't seem ludicrous.
Yeah, there was so much technological progress in the first half of the 20th century, way more than took place in the second half of the 20th century. So go back to the 1920s when this was going on. Almost every household, the big technology that was spreading to everyone back then was radio, which you have to put yourself in the shoes of someone in 1920. There's a box in your room with someone speaking out of it, and this person speaking out of it lives 1,000 miles away. That was like indistinguishable from magic back then. And the other two big inventions that were really taking hold back then were the car and the airplane, which were those two, particularly the airplane. It was hard to distinguish that from magic. If you were born, in 1880 and you grew up on horseback with wagons, and then all of a sudden there's planes flying around and a box in your living room talking to you. The idea that economists couldn't figure out a way to just stop the economy from collapsing that did not seem like it was wild at all. I also think it's interesting that right before the economy fell to pieces this year, in the last couple of years, there were people who were saying something very similar. And to be honest, I bought and still kind of buy this to a limited degree, that the Federal Reserve knows how to arrest economic collapses better than they did in previous times. I say that slowly because I know there's so many qualifications to that statement, but I think they're better at what they do than they have been in the past. There's risk to that, et cetera, et cetera, et cetera. But it's funny that here we are 100 years later and people are saying the same thing right before we have the biggest economic crisis since the Great Depression. So here's another example of just history repeating itself.
Yeah, well, it's interesting, John Burr Williams, who you mentioned, Morgan, when he writes that book in 1938, and one of the big things he talks about in the introduction of that book is trying to solve the business cycle. So he said, look, markets are too volatile, and I'm writing this book so we can solve market volatility, because markets shouldn't be volatile, is what he's saying. And his book is fascinating. It's a time capsule. He Harvard Business School guy, and he envisions getting, all the experts from the textile industry, and they would all come together and they would conclude their shared forecasts of earnings and their shared forecasts of what the discount rate for each industry is. And then people would just know the value of every stock, right? It would just be sort of set by like a planning committee at Harvard Business School. And that was his vision for how to end market volatility, right? So the discounted cash flow model, in some sense, was a response to what we saw in the 20s and 30s of people saying, hey, we need to restore some rationality to the market, right? This seems wildly irrational. And I think that one of the reasons why, despite all that technological progress, the business cycle maintained such a stubborn problem was that, I think to Morgan's excellent point, it's about investor psychology. And I think the biggest problem with John Burr Williams' thesis and with the discounted cash flow more broadly is the unpredictability of the future. And that at any given time, right, the future is not inevitable. It's a contingent. It's a result of choices. It's a result of circumstances beyond our control or understanding. At any given time, there are multiple possible futures, all of which are equally rational. We could all come up with 5 different forecasts for what's going to happen, back it with great data, and all be completely wrong. And so what you see in with market volatility is the changing pricing models, the changing investor psychology, the way that investors change their understanding of how to interpret historical facts and translate that historical fact into a forecast of future earnings and future discount rates. And that's why markets retain this stubborn volatility, and why business cycles are still with us, because we cannot remove that element of human psychology, human speculation, and I think the acknowledgement that the markets are discounting or trying to forecast a completely unpredictable future.
Yeah, you have to admire the confidence of someone just saying like, all right, this is ridiculous. I'm just going to get everyone together and we're going to stop business cycles. Like, we're just going to sit down, get in a room and figure it out. Morgan had a great tweet a couple months ago where I think you showed, Morgan, like just a calendar or like Google Trends of market forecasts that were like end of December, early January. And to Dan's point about how quickly those just become meaningless, it's like no outlook would have said, you know, we expect this year to be a global pandemic that's going to shut down like most of the global economy. And so it's just like within 3 weeks of these 2020 forecasts, they were all irrelevant because everything just went out the window. And yeah. I think that's just a modern example of how little you can predict about the future.
And there's so many of the during these big events like we've had this year and 2008 and 9/11 and whatnot that are just dictated by like the random tiny little trivia and accident. In 2008, for example, so much of the financial crisis and the decade slog that came after that was Lehman Brothers collapsing, just that one single event. Well, in September of 2008, Barclays was very close to purchasing Lehman Brothers. That would have prevented Lehman Brothers collapse. And I might not be getting these details exact. I'm just spitting this off the top of my head. But the reason that Barclays could not complete that transaction was because the UK regulators just couldn't move fast enough. A lot of which was because this was taking place on the weekend and they just couldn't get everyone in the room together to get it done fast enough. Like, what if they had? What if the regulators could just foresee what was going to happen and be like, okay, let's just approve it and get it done with? Barclays buys Lehman Brothers. It's possible that there's no great financial crisis as we know it today. And it was just the tiny little trivia and accident of these regulators, excuse me, in the UK getting that done. So there's a lot of events like that where just these tiny, it's just this chaos theory of this tiny little know-nothing thing that no one would think about leading to something enormous. Excuse me. That was true in the Great Depression as well, where the Great Depression for the first year or two was just a very bad recession. It didn't turn into a depression until really about 1932. And what really set it off was global banks all over the world started failing. That was when it turned from a stock market bust and an unemployment rise to a complete banking catastrophe. And a lot of that was set off by one bank in Vienna called Credit Ansal that collapsed, that set off a wave of bank failures across Europe, hit London, and then eventually made their way to New York. So there's all these just like, there's so much embedded leverage in the system, not necessarily financial leverage, although there's that too, but there's so much just, signaling that takes place when that happened. One bank fails and then people get worried and then another bank fails and then it's just like dominoes from there. So that's why it's just incredibly difficult to predict with any sort of confidence or precision what's going to happen next, particularly during the big events, which are what move the needle the most in history.
Yeah, and before we get to Dan and financial accelerators, another good example of that, I think, in this kind of idea of like a catalyst just triggering all these knock-on effects that you wouldn't kind of be able to predict. I think the Panic of 1907 is an excellent example because a couple months or maybe up to a year before the Panic in 1907 kind of really broke out, one of the main triggers was actually the 1906 earthquake in San Francisco, because there was this weird kind of, setup where over 50% of the fire insurance companies in San Francisco were British. They had just been like the first ones to set up, they were British, and it just kind of kept going. So there are all these British firms. And what people don't know about the 1906 earthquake, and I didn't know until recently, is that it wasn't actually the earthquake that did the most damage. It was the fires afterwards, because the earthquakes took out the city's water mains. And so for 4 days, there was like blazing fires that took out, I think, like 250,000 blocks, made upwards of 70% of the city's population homeless. And no one could put out the fires because there was literally no water. Like there were fire teams, but they couldn't do anything. And then from there, because it was all these British fire insurance firms, Britain had to send all these, I think it ended up being like 14% of their nation's gold supply to San Francisco to pay out these claims. And after they had to send out so much gold from their gold reserves, the Bank of England hiked rates unexpectedly really high, which had an effect on like the New York financial markets. And then there was just this whole knock-on effect of something that you couldn't predict, and like a natural disaster which seems kind of akin to predicting a global pandemic. You can't.
And you hear things like that, and that's when it's just like, why even try to predict what's going to happen next? Like, it's so appealing too, because you think that we should be able to, considering like how smart society is, how much data we have, and how much intelligence we have. But then you hear stuff like that, and it's like, why are we even trying this? I remember another quick example. I don't want to dwell on this too much, but that's always stuck with me was that, and again, I might be getting some of these details wrong. I didn't study for this beforehand, but in the 1920s, Hitler was involved in a beer hall shootout, and he was actually shot in the shoulder during that period. He was wounded. Someone once mentioned the idea, like, what if the person who shot him had aimed his gun like 4 inches in the other direction, and Hitler was killed in the 1920s? Everything about the 20th century would have been completely different. If this tiniest little example, you could go on with those for days.
Dan, I know you're a man of history.
Well, I was just going to add to that. I think one of the other funny things, one of my favorite, getting to the sort of why do we even make forecasts, one of my favorite things is when there are financial stories that say, uncertainty is really rising, right? Or, the markets are more uncertain. And you sort of think, well, so they were really certain in January, right? And then COVID hits. And you're also going, oh, we're so uncertain now. And you're like, well, where was the error? Is the error now that we're uncertain, or was the error in January when we were certain, right? And I think my view is that, when we talk about these events, right, that famous quote, what happened, events, dear, events, right? I mean, events shape history, but, there are almost two types of events, right? There are these chain reaction domino trigger events, right, where Hitler gets shot or doesn't get shot, or a certain fire catches, or the Archduke gets assassinated, and for reasons that are sort of incomprehensible, right? The domino chain falls, and it leads to much, much bigger events, right? And then I think there's another type of event, which Lehman Brothers is more, or a bank failure, right? These are what I would call salient events. And there's a ton of really interesting research by sort of the top behavioral economists at the moment. Andre Schleifer and Charles Lee and a few others are working on, which is this new theory about salient events, right? Which is basically, their argument is that people form pricing models based on recent experience. So they sort of say, okay, well, based on what I've experienced, this is the way I think the world should work. And the more that pricing model seems right? The more years that go by with the truths that uphold that view of reality holding true, the further and further their confidence grows as it occurs to them, right, that their pricing model is more and more certain. And then he says, well, then there's a salient event, right, that shows that model was actually wrong. And that is one of the things that then causes big market volatility shifts, right? So you can think about some, basic assumptions that I think a lot of US investors have, right? Like software is eating the world. SaaS software businesses are great companies. Amazon is a high growth business, right? I'm not saying that none of those things are true, but a salient event would be something like Amazon reporting negative year-over-year revenue numbers, right? Or, a major SaaS software company going bankrupt for cash flow problems, or, these types of things which seem almost inconceivable, right? That Blackstone blows up or something, right? And you're just saying, wow, everything I thought I knew in my pricing model has just been challenged. Therefore, my whole expectation of the world shifts and market volatility goes way, way up.
Right.
I think that,
we just mentioned like how futile it can be to make forecasts. But if you just think about, rather than a specific forecast, just an expectation, to your point, Dan, if you take the big 5 companies, Amazon, Microsoft, Google, Apple, and who am I leaving out here? What's the other one? Anyways, the big 5 tech companies, people know who they are. The odds that one of them is out of business in the next, let's say, 20 years, if you just think historically about the path of business, the odds that one of those companies is out of business or close to it in the next 20 years is very high. But it's almost inconceivable to think about Google going out of business in the next 20 years. But historically, that's the path of business.
Right, which challenges our CFA assumption of a perpetuity, right? It's like, at the end of your discounted cash flow, it's a sign of perpetuity. And I've always wondered, it's like, well, isn't the statistical history of companies that they don't live on for forever? Like, shouldn't we have a terminal rate where we assume they die after 5 years or something?
It's so hard to think about that. in real time. And even companies that don't die, companies like AT&T and IBM and whatnot. IBM is probably the best example of, it's hard to exaggerate IBM's dominance in the 70s and 80s. It was like if Google and Amazon and Facebook and Microsoft merged today. Like that's what IBM used to be. And now it's just a shell of its former self. I mean, it's still a profitable company, it's still a very large company, but a shell of its former self by any definition.
Right, Nokia.
Maybe going back a little.
Nokia, right.
Going back a little bit further, Sears, I mean, the kind of original Amazon. For another kind of podcast I was doing on the 1918 Spanish flu, and some of the research I was doing, I found that there was actually an Amazon effect during the Spanish flu, where Sears, Roebuck, and Montgomery Ward, which were mail order catalog companies, they saw an uptick during the second wave of the Spanish flu during the worst months, October and November, where because people were, like today, at home, they were ordering more supplies and goods through Sears and Montgomery Ward because they weren't going to retail outlet stores and brick and mortar. And so again, Sears was the Amazon, but we all know how Sears has kind of gone in recent decades and in recent years, more specifically. So again, it's just interesting to think, though, that no one would think that Sears would have that kind of future when it was so dominant for so long.
And Sears too is interesting. It's very comparable to Amazon, where Amazon started as an online book company, and now AWS and everything, they're so diversified. Sears, this was not even that long ago, the 1980s, was diversifying outside of retail. They were so dominant in retail and were spinning off so much cash from that they were getting into insurance, stock brokerages, like car insurance. They were this big financial conglomerate as well. And that's why if you go back and read what people are saying about Sears in the 1980s, it's almost exactly what people are saying about Amazon today. Not that they're a good retailer, but just that they are just a business titan that can take over any industry that it wants to.
Yeah. Dan, to your point earlier about the kind of salient event, one that I think it hasn't had as profound kind of a shock as the ones that you were describing, but I feel like within the kind of VC world that WeWork, that whole debacle kind of pegged down investors' enthusiasm a bit, and everyone became more skeptical of kind of these unicorns in Silicon Valley and everything, where it didn't cause a crash or anything in Silicon Valley, but I feel like it was a reality check where it's like, oh yeah, maybe some of these companies that have exciting narratives aren't actually worth $50 billion or whatever it was. And now SoftBank is kind of more laughed at. I mean, definitely like the finance Twitter scene, whereas a couple of years ago, it was a different perspective. But
yeah, and you think about that, how these events, how the narrative of WeWork shapes the investor narrative, right? That's the sort of the salience of it, right? And I mean, it's not that dissimilar from how writers or journalists write, right? You pick a salient story and you let that story speak as, a metonym for a whole piece of history, right? This is just the way the human brain works, right? If you hear, 1 out of X thousand people die of X, right? You're like, okay, I don't care. And then you're like, did you hear that Bob's grandmother died? You're like, oh, Bob's grandmother died. Wow, it really speaks to me now, right? But it changes your narrative, right? So I think, and you can see the decline and fall of different investment narratives, right? So, WeWork, what investor narrative did that challenge? Well, I think it challenged the sort of super scaling, right? It's just like, pick an industry and flood it with money so you can fund the market leader as fast as possible, right? And you saw people really trying that. They tried it with the electric bikes and scooters, right? So all we need to do is flood this market with money to become the market leader as fast as possible. And that's the path to victory, right? And there were other fascinating narratives. I remember the Valiant, right? One of the really interesting stories of the early 2010s, right? You had this very important narrative around, how brilliant this ex-McKinsey pharma guy was. But there's this whole model around, pharma companies spend too much on R&D, and if you just cut R&D and raise prices, and all of a sudden, everyone in the life sciences, right, every pharma investors, when Valiant started to blow up, right, that whole narrative that was driving so many other investment decisions changed. And you can think of what impact COVID has had on some of them, right? Think about all the narrative about certain businesses being recession-proof. Veterinary businesses, recession-proof. Dentists, recession-proof, right? Well, how long did that last before people realized, holy smokes, well, recession-proof unless the recession is caused by like a disease that, forces you to not go to the dentist or take your dog in to get spayed, right? I mean, so you see the fragility of these investor meta-narratives because they're so driven in some cases by a few salient success stories that then drive sort of Me Too and imitators. And if the imitators then work, that's when you have, huge speculative problems.
One other point that I think is that plays a big role here is that even if you know something is unsustainable, even if you know with confidence that something is a bubble, just because something is unsustainable doesn't mean you know when it is going to end. And particularly if you are in the professional forecasting business, being 2 years early or 1 year early is indistinguishable from being wrong. There's this great quote that I love from a book about the 1990s stock run-up. The book is called Bull by Maggie Mahar. And she quotes someone in there, I forget who she's quoting, but she says, they're talking about the 1990s, and he says, at some point, you can't just keep telling your clients that the PE ratio is too high. You can't just years and expect to be, even if we know, like in hindsight, that was the right thing to do, you can't just say that for 5 years and expect people to take you seriously. It was 1996 that Alan Greenspan first used the phrase irrational exuberance, and the market kept going for another 4 or 5 years. Same with the housing bubble in the 2000s. Like by any rational metric, there was a US housing bubble by 2003, but it kept going until 2006. So because of that, we just don't it's from a person who's commenting on this or advising clients or trying to maintain their own reputation, particularly take something like WeWork. This is all hindsight, of course, but you could say it was obvious in hindsight that was not going to last. That's hindsight. I know, but this is a company that's not even remotely profitable. That's just burning ridiculous sums of money. But if you went back into 2014 and said, this is not sustainable, you were wrong for another 5 years. And you just can't do that in this industry. You can't be someone who's taken seriously by anyone if you're going to be 5 years early on every call that you make. So that's why it gets difficult for someone like me trying to make sense of this to look at something and I can think that really looks unsustainable, but I'm not going to make a call on it anytime soon because crazy behavior can last for a long, long time before it ends up.
And I think crazy behavior also, it works better in bull markets, right? People will give people a lot of leash, right? I mean, I think another great salient story is Amazon, right? Amazon for years burns cash, negative net income, right? I mean, all the value investors, right, were saying, wow, Amazon, how they lose money every year selling low margin goods online, right? That's got to be unsustainable. And then, the business sort of rocket ships out of that, right? And you just see that this is this brilliant strategy being executed. Yet all of a sudden, what's interesting is, obviously Amazon is a success story, but now so many investors have that in their minds. Oh, negative net income, negative cash flow for years and years is not necessarily a bad thing. In fact, it can be a very good thing if it leads to an Amazon-like outcome, right? So, and I think a lot of value investors say, if I was wrong on Amazon, maybe I'd be wrong in this individual case. So maybe I shouldn't be so vociferous in criticizing money-losing companies, right? Maybe a lot of them do make sense. And I think in good times, right, people are willing to finance that stuff. And the more money that goes to financing it, the more chances that company has to kind of get it right? Tesla is another classic example, right? I mean, every value investor that tells them way overvalued, there's no way it's justified. Here are the million problems of the business model. But as long as investors are willing to give Elon Musk money, and as long as he's willing to iterate, right, what are the chances he solves some of those problems, right?
Yes.
And then ends up doing something spectacular because he's been given enough room to actually grow and create. I mean, and you think, how many more examples of that situation do you need for investors to get it in their heads that they really shouldn't care whether a company's profitable or not?
Absolutely. I think something that a lot of investors that they underappreciate is how much impact Facebook's story has had on the entire kind of venture and tech ecosystem in the last decade. Because Facebook was a company that in its early years, even in its first 5 years, did not care about revenue or profits. And it was one of the first companies to really be taken seriously that was like, we're not doing this for profits. We're just building a cool tool because we think it's awesome. But we're not really concerned about that. They raised enough money and they were low cost. And then around 2010, 2012, more or less, I'm oversimplifying this, but they basically just flipped the switch and said, okay, we're going to start monetizing. And overnight, they started minting $20 billion in profits. And look, people underestimate how rare that story is, but because that story was so powerful, it gave kind of this free card for tech companies to say, well, just like Facebook did in our first 10 years, we don't care about revenue. We don't care about profits. We don't care about it. We'll figure it out later like Facebook did. But it's such a rare story that Facebook was able to pull that off that you now have an entire ecosystem that almost looks like profits, like looks down on profits. Like profits, we don't, like that's for old like steel companies. We don't do profits. Like we're trying to do technology here. And I think all of that is rooted in Facebook's success over the last 10 years.
Well, it's also like Uber after Uber's success. And it's like, there's Uber for everything. There's Uber for dog walking. There's Uber for car washes. Like everything was Uber for something. And that was just like the meme. And again, it's because people saw like the ridiculous like amount of money that had been made in early investors from Uber. And it's like, oh, so we'll just pitch that we're that for some other thing that's totally unrelated and not comparable.
And Dan brought up a really good point, which is that some of these narratives become self-fulfilling prophecies. Like as long as people believe in Elon Musk, they'll give him money. And as long as they give him money, he'll solve some of these problems. You know, he like SpaceX is the perfect example. SpaceX was so ridiculed 10 years ago. Who is this 30-something tech entrepreneur named Musk from South Africa I've never heard of? He's going to take on NASA? Are you kidding me? This is a joke. But he did it. There's people in space right now because of SpaceX. So as long as a narrative remains alive, real legitimate problems can be solved that actually break out of the bubble narrative, and they actually become actual good, profitable companies.
It's like genetic mutation, you know, right? Like there's all this genetic mutation, right? And most of the mutations are bad and cancerous and lead to death. And then every once in a while, like 1 in a million leads to some transformative positive outcome. There's a great New Yorker article a few years back that was talking about how maybe the great benefit of Silicon Valley, or even the great benefit of American capitalism in the 2010s, right, is providing so much free money to provide for this, you know, an ecosystem in which that mutation could happen, in which that innovation could happen, right? Even though we sort of all instinctively knew that the base rates for that type of innovation actually succeeding were so minimal. But as long as we were willing to fund 1 million of them, because just one worked, and that story was what we were hearing, right? You know, I sort of, when I was at Stanford Business School, you know, one of the questions one of my classmates had is, you know, they promote entrepreneurship so much, you know, why don't they ever show the statistics of like what % of people go into business? You know, what is the entrepreneurial success rate? What are the people who go into entrepreneurship? What is their income compared to people who didn't go into entrepreneurship, right? We have all the entrepreneurs come back and speak. Right. And you say, well, you know, maybe that's by design, right? Like maybe Stanford wouldn't be such a productive entrepreneur factory if people just were focused on the base rates instead of the guest speakers.
And so
totally agree with
that. Base rates.
No, yeah, Jim, go ahead.
Bringing up base rates and how much we're talking about human psychology getting in the way of kind of good investing outcomes. I think that's a good way to pivot to the in-depth report that you and your team did recently, Dan, on crisis investing, which is definitely more relevant than it's been for a lot of people right now. What were the kind of main takeaways from that paper, and what was the research, like the scope of the research that you guys were doing for those who haven't read it?
Yeah, so we were looking at basically every financial crisis since 1970, what caused it and what were the common patterns that recurred in these crises. And then once you were in a crisis, and our sort of, you know, premise was it's very difficult to predict the next recession, right? You sort of, as Morgan put, you know, you're 2 years too early or 5 years too early. You predict 10 out of the last 3 recessions, right? This is a very difficult game. But everyone basically knows when you're in a crisis, right? Really not hard to tell. Some very simple financial indicators. You're like, oh, yep, we're in a crisis, right? Stock market's down 20%. Everybody's panicking. We're in a crisis. So given that the knowability, right? We know we're in that situation, right? What are the set of things that work? Like, what should you do? What's the game plan that you should follow? And that was our goal, right? Was to try to say, okay, in this, and as it turns out, which is really interesting, is that crises are actually very similar in a lot of ways. And actually what you should do in a crisis is actually very similar. And in fact, many simple quantitative rules work better in times of crisis for the same reasons we talked about with Elon Musk and Tesla, right? When there's free money, a lot of things get funded, many of which are dumb. Some of the dumb things end up working. And then, you get these sort of odds-defying things that happen in a bull market. But in a bear market, people don't get that chance to defy the odds, right? Because, and this is, I think, a really key idea from our report, and one of the things we focused a lot on is also relevant to what's going on now in the Federal Reserve, is this idea of the Financial Accelerator. So why do small events, why do these butterfly wings of history turn into big crises, right? And the answer is something called the Financial Accelerator, right? And the Financial Accelerator, this is Ben Bernanke's, some of his seminal academic works on the Financial Accelerator. It's why he was brought into the Fed in 2008. And what he says is basically once this event happens, the financial system changes its behavior, right? Something bad happens, and then the banks and the investors change their behavior in predictable ways. They say uncertainty has gone up. I should slow the pace of new lending. I should slow the pace of new investment, right? I should just stop investing until the dust settles and we know what's changed and what I should do. I'm going to build cash. It's probably smart to have cash right now, right? There's going to be a lot of opportunities in the months to come. So until we figure out what to do, let's hold cash, right? That investor psychology is so common across every one of these crises, right? I mean, Morgan's research is so on point on this, right? It's like don't play the puck, play the man, right? What's the man thinking in a time of crisis? Virtually the same thing in every crisis, right? And as a result of those financing decisions, right, there's a whole, cascading wave of things that happen. Right? Once new investment gets cut off and new lending gets cut off, firms that are reliant on financing change their behavior. Okay, if they were going to borrow to build a new factory, they can't borrow to build a factory, so the factory plans get canceled. So the construction company that's going to build a factory, they lose revenue. Right? The company that needed to refinance in March of 2020 goes bankrupt instead of refinancing. And because it goes bankrupt, right, you see these kind of feedback effects. And so what started out maybe as a small event through the impact of the Financial Accelerator becomes a very big crisis. And so if you think then of what the Federal Reserve playbook in the Bernanke's playbook as he designed it was to say, you have to arrest the Financial Accelerator. The Federal Reserve has to stop this reduction in new lending and this reduction in new investment, right? We need to provide reassurance to markets. In 2008, they focused on the banks, right? Most lending was done by the banks. They said, what we need to do is inject capital to banks and basically force the banks to issue new loans. They then issued a bunch of financial regulations after the crisis that pushed a whole bunch of lending, especially riskier forms of lending, off bank balance sheets. So when it comes around to this crisis, they couldn't go straight to the banks. What they had to go to was straight into the market, right? They had to go into the credit market and buy high yield bonds, buy corporate credit. And their goal in doing that was, again, to follow Bernanke's playbook. We've got to arrest the Financial Accelerator to get money flowing back into the system, to keep liquidity going so that this small shock, and COVID maybe was a bigger shock, but doesn't turn into a major crisis, that the Financial Accelerator stops. And if you think that as an investor, and what's one of the things that's made this dynamic challenging, but if you think of as an investor, what you want to do in those moments, historically what you've wanted to do is look for companies that are profitable and cash flow positive, that will survive the recession, that are trading at very low prices as a result of the recession, right? So you're getting a bargain, other people are selling you stuff really cheap, they're panicking, but it's not going to go bankrupt. And then the other key thing is, if you think about why it's cheap, the reason that you want it to be cheap is because liquidity has been gone out the window, right? So it's a small company, it's illiquid, right? So the market liquidity is the problem rather than the business's fundamental health, right? So you buy a fundamentally healthy business at very low prices because of a market volatility panic. That has historically been what to do in a crisis. Now, what happened in this particular crisis, which is interesting, is that everything happened so fast, right? The market sold off really fast. Then the Fed took their playbook from 2008, executed it like perfectly within like a few weeks, right? So investors had actually a very narrow window in which they could have deployed money into these illiquid markets, right? There's a really narrow window actually this time when you could have gone and bought corporate bonds or even large cap stocks. I think the window for small cap stocks has been a lot larger, fortunately. But in terms of large cap stocks or investment grade bonds, it was a very narrow window as a result of the Fed's very aggressive actions to arrest the Financial Accelerator.
So one other thing. Go ahead, Morgan.
Dan, and Jamie, I'm curious what you think about this too. I've heard a couple of people say, I don't know where I fall on this. I'm just curious where you say that the policy response so far, the story's not over, but the policy response so far in 2020 is probably the best economic policy response ever at both the federal government and the Federal Reserve level. I don't know where I stand on that. Just curious your thoughts to that comment.
I think it depends on what your goals are, right? If you say my goal is to prevent financial crises and mass bankruptcies from happening in America, then the answer is absolutely yes, right? It's been phenomenal and very fast, very quick decision making. On the other hand, if you have sort of a moral view that the government should not prevent moral hazard, that we should let bad actors fail, right? Then I think, you come to a very different view. So I think it just depends on the moral lens through which you look through it. But from a purely economic perspective, I think it's hard to argue with the effectiveness of central bank action in this particular event.
And I think what's so different about this relative to 2008 is because I agree with you. And I think most people would agree with bad actors shouldn't be saved. But there were clearly bad actors in 2008 with the intentional decisions that banks made and AIG made and Lehman Brothers made. They dug their own grave. That's what you had to do it yourself. Whereas this is a purely, just getting hit with a meteor that no one saw coming, a virus that no one saw coming. And you can say companies should have been better prepared, should have had more cushion, less leverage, et cetera, et cetera. But it's hard to pin bad actors, particularly at the corporate level in 2020. And I wonder if that argues more, this is a topic that everyone's going to have a different opinion on, but I wonder if that argues more for just blanket support than existed in 2008.
Right.
And it's a tough decision. I'm glad I'm not a policymaker making these decisions.
Me too. I'm glad we get to sit and just commentate on this stuff more.
So much easier.
So now we're going to pivot to some questions, and just a reminder to the people who are watching that you can submit questions, and we will take a look at them, try and answer as many as we can. So I'm just going to alternate between you guys, and obviously the other person can chime in and give their take as well. But I'll start with Morgan. This is actually perfect for both of you. Morgan, because you're in VC, and Dan, because you're at war with PE. So one question is, how do you think the vast amount of capital in all areas, parentheses, VC, private equity, et cetera, will change this behavioral psychology? Do you think the incentives of allocating money will make people more rational? For example, in this recession, in the past, investors may have stopped allocating to money-losing firms, but this time, since there is so much capital, investors may continue funding these companies. Morgan, start with you, and then Dan, pivot to you.
Yeah, I think the most fundamental way to think about that would be to say, is the amount of the increase in capital that's occurred in VC in the last decade, has that increased entrepreneurship? Has that actually led, now that there's more supply, there's more capital going into, are we funding more breakthrough businesses than we were before? This might sound cynical, but I think the answer is probably no. I haven't seen much evidence that because the amount of capital in VC has surged to the level that it has, that more people, we have more groundbreaking technology than we did before. So I think that roughly the same number of great businesses are being funded that have been for forever. But there's definitely an increase in companies that have lower prospects that are able to raise not just VC rounds, but large VC rounds. So that's just kind of, since VC is such a tail-driven industry, as long as there are a couple of huge winners, if just looking at the entire industry, then adding on even a large number of companies that are significantly less successful doesn't necessarily change the prospect of the industry to a large degree. Valuations in VC have risen substantially in the last decade, which is just, there's so much more capital chasing the few good deals that are out there, the few really companies that have significantly higher prospects than others. Those companies are just being flooded with capital. And since it's not like a public market where anyone can go buy Apple stock as long as you have a brokerage account. In public markets, you kind of have to win deals. So that pressure to win deals for VC firms has just been increased substantially over time. Now that we're in this, maybe you call it an inflection point. And I think another big catalyst for the inflection point was what looks like, I don't know if you want to call it failure, but the non-success, let's say, of the SoftBank Vision Fund, which was a big thing for the industry. If that worked, that would have set off a huge range of fundraising of people raising $50 billion funds, $100 billion funds, because they would have said, hey, like SoftBank can do it, we can do it too. Now that it's not worked, I think there'll be a lot more skepticism from that. And I'm curious to see what that does to just overall assets in the industry. But I'm not sure what it does to people's incentives. There is a thing, a lot of people have very divergent views on this, and some people think it's great, some people think it's awful. But since VCs are not, and private equity doesn't have daily market quotations like you do in public markets, you have this thing where it looks on paper less risky, because in March of 2020, your public market fund fell 35%, but your private equity funds were flat for the month because they're just not marked that much. Some people will say, well, that's ridiculous. You're just hiding the risk. Some people will say, no, that's actually a feature. That's not a bug, because you don't have to pay attention to short-term market prices if you're a long-term investor. I honestly don't know where I sit on that spectrum. I do think there is an irony that most financial advisors during March of 2020, let's say, will tell their clients, this is a short-term decline. We're thinking long-term, don't pay attention to what's going on. But then when you frame it as VCs didn't have to mark their books in March 2020, they'll say, well, that's wrong. You should have to mark your books. There is some disconnect there. I don't know where I sit on that spectrum, but it is true that in private markets, you don't see as much volatility, even if there is as much business volatility, which of course there is. Maybe there's more because there's leveraging involved in private equity to a larger degree, but you don't have to see it to the extent that you do in public markets. And if you take the view that investing behavior, your ability to endure volatility and react to volatility with a more with a level head, if you view that as like the fundamental puzzle piece of investing that you need to solve for, then maybe there is something to VC and private equity or just private markets that, since you don't have to look at the volatility, even if it's technically there, it can manage your behavior to a greater degree. Dan, as Jamie said, you are at war with private equity. I don't know if you'd agree with that framing, but I'm curious what you think about that topic.
Yeah, well, I think, if to use your logic, Morgan, that reacting to volatility is perhaps the great test of an investor, right? I mean, one of the most interesting things, and we predicted this in our crisis investing paper because it's a pattern that recurs in every crisis, is that private market deal flow shuts off. So if you look at like Q1 and Q2 of 2020 private equity deal activity, it's down like 80 or 90% from last year, right? Like it just stopped, right? So if you think of like, wow, this is probably the best, March of 2020 was probably the best time to go out and buy businesses in like 10 years or something, right? How much money got put to work, right, in that quarter? And the answer is so much less than got put to work in what was obviously, in hindsight, a worse time, which was March of 2019, right? So, it's a fascinating dynamic of private markets. They do tend to be very pro-cyclical for a whole variety of reasons. One of them is they have to call capital, right? So, one of them is that you have to find people out who want to sell at that time. And the third is specific to private equity, you also have to get debt financing, right? And because the Financial Accelerator, debt markets close in time of crisis. So your funding sources get cut off. So you can't just blame the PE guys, right? They're both their deal sourcing and their deal funding have been cut off. So they can't do anything. And then I think there's the question of the marks. And to your point, Morgan, I think this is the volatility smoothing is such a valuable service, right? Because I think everyone from John Burr Williams on has known that volatility is a bad thing, right? It messes with people's heads. It leads to bad decision making, right? So if you could reduce that volatility, that's a very valuable service. Wouldn't that be great if we could just reduce the volatility of the stock market, right? It would be nice. And I think that my question is, if that is a good thing and a valuable thing, right, should you earn a illiquidity premium or should you pay an illiquidity premium in order to get that service? And my hypothesis is that increasingly over the years, people like that service a heck of a lot, and most likely they are going to pay to get it.
I think you're absolutely right. I think that's it's hard to argue against that. That if you were to look at, Dan, you've talked about this a lot as well, but if you look at the era in which private equity worked very well, I don't know if you define that, the 80s, 90s maybe, that was when the illiquidity premium really existed. And does it exist anymore? It's hard to say. I've seen some people use some metrics to show that it does, but I think it's hard to argue that it exists in any significant amount anymore.
Right. And just the logic of why it would exist, right? Do investors think that private markets are so much more risky and there are so few of them willing to venture into it because they're so scared of illiquidity risk right now. Quite the opposite.
Right. Yep.
So moving on to the next question, and this time we're going to start with Dan. Someone asks, thinking of the lessons of day traders in the late 1990s, what are your general thoughts on Robinhood and zero commissions platforms that are attracting young novice investors into trading? It is crazy. I think the Wall Street Journal put out charts where it's like the number of daily trades, I think it was TD or something, like, and the line of when commission-free trading started, and it was just like straight up after that. It's just,
I think part of the lockdown, I think people are bored and want to gamble, right? So I think that I think that's part of the why. Zero commissions and then locking people in their houses and shutting down sports. But then, I think what's interesting has been, everyone says retail is dumb money, right? But retail's been actually like quite smart money, right? Like who was putting money into the market in March, right? It wasn't the institutional investors. It wasn't private equity, right? It wasn't any of these things. It was retail people who said, wow, things are down a lot. I should probably go buy some airline stocks, right? Right? And turned out buying pretty much anything in March was a good idea. Now, I think with all the praise that I think retail investors and Vanguard investors deserve for their behavior during this crisis, which I think is ample, right? I think we have to revisit our sort of casual mockery of retail investors. So it looks like they're actually smarter in many ways than the smart money. There are, tail ends, right? The gambling on bankrupt company stocks like Hertz. I mean, that's right. There's sort of like, hey, should you have bought the market in March type good behavior from retail investors? Should you have bought pretty much anything, right? Good idea. Other than Hertz and Chesapeake Energy and the other bankrupt companies, which were probably not the best place for you to be gambling.
Morgan, do you have any thoughts on that?
Yeah, my view is really colored on this right now from a story that many people have probably heard of. It's kind of going viral around this week, but a really tragic story about a 20-year-old Robinhood trader who woke up last week and logged into his account, and the account showed that he had a negative $730,000 balance. He was trading options. He did not have nearly that much money. It was just, I think he started the account with $10,000 and it quickly ballooned into negative $730,000, and he committed suicide the next day. Oh. And it turns out that it was actually a UI. He did not owe $730,000. It's just like some options trades hadn't settled yet. It's a different story, but it drives home the point that this is not a game. That investing is, I love investing. I think investing is very valuable, but as soon as you frame it as this is a game, people get hurt. And people can get really hurt doing this. So if you had asked me 2 weeks ago what's going on with the Robinhood, I would have said, great, I'm glad that young people are investing, and they'll, look, from the looks of it, they're going to lose a lot of money, but you got to learn your lessons. And something like this happens, and it's just a reminder that this is real life, and this is, you can hurt people doing this. So I hope some changes come out of that.
Definitely.
Not to lead this down a tragic story, but it's in the news lately. So that's what I've been thinking about.
Yeah, no, I mean, it's important to remember. Question from Morgan. Someone wrote in, knowing forecasting is futile, what are the rules that you follow / recommend to try and not lose money while investing?
I think the biggest thing there's two things to keep in mind that I think about, that these are kind of the foundation of how I invest personally, which is that what matters most in investing by far more than anything else is endurance. That you can just maintain, that you can remain standing when the world's falling apart. And most people underestimate how often and the degree to which the world breaks very often. I think historically the world breaks roughly once a decade on average. The breaks are always different and they're unforeseeable, but whether it is COVID or 2008 or 9/11, et cetera, the world breaks every decade. And you just have to be able to situate your finances so that you can maintain standing during the breakages, both financially and psychologically. That you can just keep in a level head and say, I'm going to keep going and keep plowing through. That skill, the ability to do that, matters more than anything in investing, matters more than stock picking, matters more than your economic knowledge, just endurance. The other thing that I think about as it relates to the inability to forecast is the difference between a forecast and an expectation. They seem really similar, but they're very different. A forecast is we're going to have a recession in November of 2023. That's a forecast. An expectation is we're going to have recessions roughly every 5 to 7 years, and I don't know when they're going to come, but I expect that they're going to come. I don't know when, I'm not going to put a date on it, but when it happens, I'm not surprised that it happens because I expect them to happen. If you can just situate yourself around expectations rather than forecasts, I think you are in a much better position, because when you realize how unpredictable the world is, from my point of view, it makes most predicting in economics futile. Like, why would you even try when you look at the history of these stuff? But rather than just becoming a fatalist and saying, well, that no one can do anything, so whatever happens is going to happen, I think it's much better to just say, I'm prepared for these things to happen based off of the historical frequency. And therefore, when something like 2020 happens, I didn't see it coming. I didn't forecast it. But when it happens, I was able to maintain a relatively calm head because I expect the world to break just as a baseline assumption. That's how I deal with it.
But just to make sure I understand, you said November 2023, right, for the recession? I don't want to write that down.
Mark it down.
And so unfortunately, we're coming to a close now. And so I want to just get some final remarks from both of you. Dan, someone on Twitter said that you have the most anti-bookcase they've ever seen. So maybe you want to explain why you have.
We moved into a new house and our furniture arrives tomorrow. And so I have no books at the moment. So it's not a new minimalist trend that you should all adopt.
This is like Chuck Norris. Dan doesn't read books. Books read Dan.
Books. I read Marie Kondo and took it to heart.
Dan is actually illiterate. But Dan, maybe it's just some closing thoughts on where people can follow you and Verdad.
This was such a fun conversation. You can follow me on Twitter, sign up to our weekly research. Really enjoyed this conversation. Morgan, Jamie, this was a blast. So we should do it again at some point.
Same. This was a lot of fun. You can follow me on Twitter as well. That's where I do all my stuff. So thanks for doing this today. This was fun.